to continue this discussion, Europe after a succession of crises, the challenges and opportunities ahead. And I'm delighted to introduce Stefan Barry, Head of Private Capital Group and Head of Global TMT Coverage at Crédit Agricole CIB.
Good morning, everybody. So we have a very nice panel with us this morning to comment on how the industry's been going. But first of all, let me gently take you back a few years back, maybe 3 years ago, 2019. It was one of the record years for the industry. We were all doing extremely well. And the main question everybody on the panels was answering is, when is the next crisis going to happen? We all knew something was bound to break at some point in time, but what and when, nobody knew. Comes February 2020, the whole world stops. You've seen enough movies of the world empty, the streets of Paris completely empty, and that hit pretty hard. So we all spent a lot of time looking at the portfolio companies, financing needs and support given by governments and others. And then 21 came, a record year for the industry across all countries, segments, records amounts raised, records amount deployed, record valuations too. I think you all remind that a few days back. So we all thought that 21 and 22 was going to be plain sailing. And we start again, February 22, a new hit. This time, very different. We clearly have an impact. We have a financial crisis. The leveraged loan market is very difficult. Today, doing private equity deals is difficult, yet to do deals in the infrastructure and the TMT space is still quite open, okay? So that's the question we're gonna ask our panel today. We have a fantastic panel of 4 different, very large firms, very different, one from the other. I don't think they've met each other too many on transactions, but that's what we're gonna ask them, what is gonna be the lingering impact of COVID on their portfolio? And how do they see this financial crisis? What is going to be the impact on their portfolio of inflation and an increase in raw materials? So I'll let each one of them introduce themselves. With no need to introduce Benoît Vauchy from Permira, Andrea Bonomi from Invest Industrial, Jean-Luc Alavena representing Apollo, and Nick Jansa from OTPP. So Benoît, floor is yours.
Thank you. What do you want me to talk about? Just introducing myself. So I'm a partner at Permira, 15 years in that industry. I started in tech, and I'm now part of the management team of the firm.
What's the impact on your? Let's go straight to the point.
Yeah. Our 4 sectors are not very exposed to the front end of the crisis, raw material and energy price inflation. So we do largely B2B services, we do tech, we do digital consumer, we do healthcare. So for us, we're waiting to see the impact. I'm pretty sure it's coming. It's going to come in the form of demand pressure. The early signs are timid. I don't think we should take it as a reassuring factor. It's just compared to the last 2 crises we've seen, we're going to see a slower, probably longer impact. But right now, it's still very, very good performance. So it's first and foremost a financial crisis which will turn, I think, into an economic crisis.
Good morning. I'm Andrea Bonomi. I'm the founder of Invest Industrial, about 11 billion of AUM and 165 colleagues throughout the world. We invest about 60% in Southern Europe, which apparently could be perceived as a slightly riskier area. But if you have an operational improvement team, if you look at your portfolio right now, the portfolio, the changes in cost, if you prepare it well for the current environment, I mean, we're preparing for a recession, we're not preparing for COVID, we're not preparing for this. Actually, we are in that Goldilocks moment where profitability and performance are very similar to your companies are still very, very strong, and you have the beginning signs of slowdowns in certain elements of your portfolio. But I'll come back, I think, later once my colleagues have introduced themselves.
Good morning. I'm Jean-Luc Alavena. I'm, as you said, representing Apollo. It's been 16 years. By the way, I know the TKO guys are very ambitious, and they want to take over. And if you put my name with the picture of Mathieu Chabon, I don't know if Mathieu is still around, but it's the beginning of a major.
It's a potential merger, huh? That's a discreet leak.
Well, despite this, three comments. First of all, we try to invest across the cycles with different kinds of pockets at Apollo, as you know, from debt to pure equity. So we've been working in any kind of circumstances. And I'm glad we did the IPO of Veralia in October 19 with the help of Kasib. And I'm also glad we recently did 2 deals with airline companies, one of them being SAS with a distressed approach. So first comment, I think we all have to be ready to get adapted to these cycles and find the right way to deploy capital. Secondly, the only word for us is discipline. If we have low entry multiples, which is one of our main goals, and being very disciplined, not buying if we don't think we have the right multiple to face a potential crisis, we are in a good shape. And third, the recession is not certain yet. We probably have a 50% probability, or 60 in Europe, a bit less in the US. We have indeed a few issues with financing markets, but we can also work on different kinds of structures, and that's what we try to do to still deploy capital, despite the fact that you guys don't lend money.
Thank you, Jean-Luc.
This did not turn out as well as expected.
So come back on that.
Nick Jans, I'm responsible for Ontario Teachers business in Europe. Couple of comments, I guess. Any lingering after sort of effects of COVID? Look, I think it was just an acceleration of many pre-existing trends. All of us, I think, have been working towards those in terms of disruption, trying to understand how to invest in disruption. We created our own incubator about 3 years ago. Do I think that we knew that COVID was going to occur? No. Did it help dramatically in terms of accelerate that? Yes. So I think a lot of us have to make long-term decisions, not entirely sure which way the world is going to turn, but you have to make those calls. 2 seconds on inflation, because we're slightly different in terms of an organization than those of my esteemed colleagues here on the panel. Being a pension plan, and one that has its payments inflation linked, means that inflation is more important probably than anything else you can possibly imagine. It matters on the asset side, because companies are clearly impacted by inflation so far, maybe not entirely obviously, but ultimately asset values, when margins start to contract and raw materials and costs go up, very important to asset values. But for us, the liabilities is even more important, because we have to find a way to make sure we can make a real return of at least 4% to keep our plan fully funded. 4% doesn't sound a lot when inflation is 0. 4% real means nominal of 10, 11, 12 across a 250 billion portfolio when inflation is high. So inflation is the single most important thing for us, because we represent teachers, public school teachers, none of whom have earned an awful lot in their lives, but they've given back to society. The one thing they require from their pension plan is that it can pay their pension when they retire at 60. And most of them now live to 80, 85. So it used to be 5, 10, 15 years, now it's 25, 30 years. So we have a promise that we're going to make sure we pay their pensions inflation linked. So we have to think about that, and we'll come back to that shortly in terms of how do you go forward, but it pervades everything and makes us think about the risk we have to take. So treasuries, fixed income, cash, none of those things generate the return you need to pay real 4%, which at the moment nominal would be 10, 11, 12.
But let's stay on that, Nick. Today, your paradigm has changed dramatically across your asset classes. So what are you going to look to invest to? How are you going to look at these new deals to deliver that kind of return to your investors? Are you going to change anything the way you do?
You want to keep going? We're going to go back this way now?
Yeah, go back that way.
Fine.
Keep going.
So I get to hold the audience a bit longer. So what we did was fundamentally shift away from heavily public markets, fixed income, quite a few years ago, towards private assets. That was the long-term trend that we've all been seeing. Principally because you have to manage actively what you've got. So we really don't actually invest very much externally. Most of the pension plans do, so we're a little bit unique like that. It's quite unusual, and we often have to explain that really all of ours is managed directly, with a very small proportion going externally. But to manage actively in private assets is one of the key things you can do to try and work through some of those issues. If you can work with companies and help them think about how they overcome these challenges, that's much more straightforward in one sense than watching what happens. The other thing is you try and move towards areas which are more protected from disruption and also from inflation. So we moved a lot of the portfolio towards what you would call inflation-sensitive assets. So we invested more into our real estate, more into our infrastructure portfolio. We invested more into natural resources, commodities, and we shifted a lot away towards those type of assets. We also then thought very carefully sectorally around the type of private companies that you wanted to invest in across private equity, which is still our largest share of our asset base, but also infrastructure, venture, credit, mixing all of those things together. And then the final two things I'd say are none of that, all of that's nice, that's all asset allocation, trying to position where you are to protect yourself. But none of it matters if you're not focused on the depletion of natural capital, i.e. climate, sustainability, and also on impact. Are you making a mark? Do you have a social license to operate? Maybe it doesn't matter for everybody, but when you've got 350,000 teachers who have your email address and want to know and look at every single thing you do every single day, you have to think about that. So it's very important that you think about how you're going to invest in the context of a changing world that's being challenged with many different aspects and how you build your asset base towards that.
Oh, it's going to be a challenge, huh? Jean-Luc, maybe is this going to be bonanza time for you? You're going to see lots of deals coming in between Vallourec and a few others. Is this going to be time for Apollo to finance your fellow friends, since I can't find them? Are you going to fund them, or are you going to look for deals? You're going to do creative transactions?
We could. First of all, I'm happy Nick mentioned all the funds that we have. So the first recommendation is you should invest in Apollo. And Fund 10 in particular that we're currently raising, but also impact, infrastructure, real estate, and everything. So we should speak afterwards. The second part is, yes, you mentioned a few companies that where we invested recently. Vallourec is a very good example. It was during the COVID crisis. The barrel was probably around $25. If you think the company has a significant position, assets, technology, and is attractive as such, it was the right time to buy the debt, negotiate with the authorities, with the court, as this was close to bankruptcy, and convert this to capital. We're going to close in a few days the deal of Ingenico, the payment terminals. You have very good assets, good market share, strong position, potential for transformation to other kinds of services, a lot of technology. This can be also a very strong basis for a new deal. The other kind of opportunity we have is, instead of doing pure buyouts, it's just having more structural equity, being a minority shareholder, or just bringing capital to companies which have opportunities for growth, or just need capital in order to have a stronger balance sheet. So there is a large spectrum of opportunities, and stay away from the sectors where inflation or recession, especially for house spendings, could have an impact. Retail is a good example. We tend to stay away or to manage the companies that we have in this sector.
Great, thank you. Thank you, Jean-Luc. Andrea, you have a long history of fantastic brands, being very on these products. How do you see things going forward? What is going to be the impact on all these brands' very marketing approach?
So you have to look ahead. So the private equity group, which did not prepare themselves for a recession, found themselves wrong-footed with COVID. The private equity groups which have not invested in operational improvement or teams or data mining or understanding, if you want, the real risks of an asset, will find themselves wrong-footed. If you look at the current environment, you'll find a deal flow, especially from family businesses, which is actually going vertical. So the stoppage of available capital during COVID, and then the moment of resetting, that there was a very brief moment of 2021, is not enough to take care of years of lack of transaction. So now, if you look at family businesses, you have an important pickup of deal flow. The issue is, can you understand this deal flow? So you've heard my colleagues speak about how they prepare for the market, how they play the nuances of the market to their advantage. It is very, very difficult right now. So if you look at any business, you have, if you take even only supply chain, you have a situation where it's no longer a just-in-time supply chain, so you cannot understand the cost structure well. You cannot understand demand, because it was easy when it was a little train and you pulled this way and the demand came the other side. But now we've had a few years where you had to stock up for COVID, stock up for raw materials, stock up for cost of shipment from Asia. You had, now you have the onshoring. So you cannot understand well what is the company's real performance. And this can be done only if you got large teams which are able to do, I spoke about before data money, are able to get to the real results of the company. So it's a very good time to invest. Forget what you see on the newspapers. Exchange rate, dollar, pound at the bottom of 35 years. And you have American investors. I was just there 2 weeks ago, and they're worried about Europe. But hang on, you are in dollars, and this is the lowest point ever. You have European markets which are a discount to the US market. You have Southern European markets which are a discount to the European markets. So why on earth would you be worried right now where pretty much every single risk is out in the open? If you can read it, if you can understand it, if you can explain it, and then if you can finance it. I mean, you're going to have a really bad time because, he says he will take up all the slacks that, they always win. They're always there, and when the time is needed. So it's a very good moment for the investing side. For the non-investment side in the portfolio, unless you had a very tight portfolio of a few companies, your portfolios are going to explode. You're going to have many more companies. So on average, I think European groups, for each strategy, have about 25 companies. When you go 25 to 35 and you don't have enough people even for the 25, it's going to be very difficult to stay on top of this company. So you're going to have, I think, a lot of, I wouldn't say mortality because private equity has a tendency not to, but you're going to have groups which are going to find themselves a little bit wrong-footed on both sides, unable to transact because they don't source, if you want, in the private markets, and unable to sell, and with companies having, covenants or other issues, even though covenants are a thing of the past right now.
Maybe not too far, huh? We're right around the corner of the covenants, huh?
I know. You're going to be very...
Benoit?
Yeah, it's interesting to listen to the panel because I think what it shows is private equity has specialized. And I don't think a crisis is a great time to change fundamentally what you do. It's a good time to refine, adjust, discipline. There's many words you could use, but you should not leave fundamentally what you're good at, what you specialize, what you've built your team to do. So we, Primera, we're all about growth, and we're all about growth in 4 sector. I mean, you could say, oh, should you leave that tech sector, which has seen a very big adjustment in valuation? To me, it would be the same thing as saying after the dot-com bubble, don't invest in digital, don't invest in tech. Imagine what you would have missed afterwards. So go back to basics. Our sector, they grow disproportionately faster, and they're going to represent a disproportionately bigger share of the economy. 2, they're much more resilient. So you start the year, between 80 and sometimes more than 100% of the revenues of the business. These are really, really good businesses to own in a tough environment. The really tricky part is valuation. So you go back to the fundamental answer, what we will have the opportunity to do in the coming vintage years is actually to buy really, really, really good businesses at more attractive prices than the last 3 years. Now, the question is, what is an attractive price? Because until we know whether base rate is going to be 4 or 5 in the US, 2 or 3 in Europe, you don't really know what exit multiple you should put in your model, and therefore you're being conservative. The banks, and I really don't want to blame them, they do the same thing. Every lender is saying the same thing. If I don't know what the cost of capital will be, I ask for extra margin, and that means it's tough to do deals. Vendors still have expectation of last year. Buyer still have, want to be conservative. But that is no different to what we've seen in every crisis. There is a hiatus of deal making, exit or entry, for a period of time, whether it lasts 12 months, 18 months, I don't know, but it will stop at some point. So if you think back to what we're telling our teams at the moment, by the way, imagine our team is probably twice as big than 5 years ago. So you need it's the first crisis for half the team. I don't call COVID as a real crisis, I'm sorry. So, and the message is, first of all, great time to focus on the portfolio. Exactly as you said, Andrea, this is the time to, push, don't waste a good crisis. It's exactly that time. And then on origination, this is all about now demonstrating that you have differentiated capabilities in specific sector, in specific type of transactions, and actually they're going to be the best deals because you will do less of them, but they're likely to be the very best deal. The one I remember in my career, and I mention it because you were critical in this, is Genesis. We bought it in 2011. You could hardly finance it. I remember the MEZ on this product was 20%. Taking 20% MEZ for private equity, that hurts. This is one of the very best deals we've done in history because if you can make the economics of the deal work at that sort of price, you're going to get a chance to reprice and you're going to buy this business at a very, very good value.
Thank you, Benoit, and a very good example on Genesis, which really built a fantastic sector. But if you listen to these gentlemen, everything's fine. They all got great opportunities, they're like business going ahead and they're going to plow ahead. But isn't that going to change the industry? I understand that clearly you've all increased quite significantly the teams on your different the staffing. A lot of firms have doubled staffing since 2001, so it's a lot of people going back to private equity. But fundraising is becoming more difficult. We hear that every day, and I'm sure quite a few know about that. Obviously, funding is difficult. Debt funding is difficult for a lot of transactions. Does that mean that some GPs are going to get stuck in this process? They're not going to be able to fundraise in time. They're going to have a very high cost of operations. They might have some distress elements in their portfolio, yes or no, but that's not the important issue. Do you think that there's going to be consolidation in the GP sector? Do you think that some of the big players are going to take the opportunity to buy the smaller players, which are not going to have the means to raise new funds or to manage things going forward? What is your view on consolidation? Maybe you don't, but if you have one, I'm happy to hear one. Benoit, I'll start with you.
So first of all, private equity GP are really tough beasts to kill. It takes a long, long time because you've got long visibility of revenues, you've got a big portfolio. So I don't expect a big death rate. Think back of the global financial crisis, everybody was predicting, there's going to be a lot of dead people. It's not true. It didn't happen. A few, but very few. I think M&A is a very, very different question. And I think what's driving this, I don't think is going to be what you just said. It's just we now have very large businesses. Jean-Luc, you're part of one, which have balance sheet, they're listed, and they now operate like normal corporate. And a normal corporate consider organic and inorganic way of growing. So you should ask the answer to the question to Jean-Luc, but I think, yes, we will see M&A.
Andrea?
I agree with everything. The only thing when people talk about buying or consolidating private equity, you're absolutely right. There is probably 20-25% of private equity houses which shouldn't be there. They're just alive. You see them. They have a brand, but they're sort of bumping along. So even if visibly they're not out of the market, they are practically, if you want, out of the market. Consolidation is going to come with a very strange, though, format. This is not a business when you buy. This is a people's business. This is a style business. This is a culture business. When you buy a private equity house, you have two results, I think. Either you do 1 + 1 = 5, or you risk doing 1 + 1 = 0.5. There is no 1 + 1, it was okay. It's a very difficult, M&A in private equity houses is a win or lose game. I don't think there's anything in the middle.
Jean-Luc?
What Benoit just said is totally correct. As soon as you have a balance sheet, or even you're listed, which is the case for some of platforms, you start doing M&A. So you have opportunities to invest or even buy funds, and a good example is a minority investment of 20% in Sofinova, for instance, which is a creation of a new business which didn't exist in the past. So number one, yes, indeed, because some of the GPs will be in difficulty, in trouble, or just because they want to grow, there will be M&A activity. Secondly, for fundraising, so far so good. There's a lot of liquidity and no real difficulty in fundraising. And third, I think Nick is the best observer of all these companies and the markets. So he certainly has an opinion on who can survive and who will disappear.
Thrive, yeah, absolutely.
That was a leading comment for me. So you're right in the sense that what you've all said, and it's interesting because each of Permira, Investor Industrial, and Apollo have specializations, some broader than others, but that's a lot of I think the critical reasons behind their success. So even though we cover almost every asset class in some form or another around the world from public to private, we don't cover each and every part of it. So we don't have a fundraising issue. We have a staying fully funded issue. So we have our own challenges, but it's not raising money, it's making sure we deliver in a different way. But we have specialists in all the areas we focus in. So in private equity, we actually don't necessarily focus on the same things as Andrea in terms of our sectors. We don't necessarily focus on some of the same things as Jean-Luc. I can't think that we have much in the way of chemicals or some of the industrial or the consumer exposure. We very much focus on other sectors. So financial services, for example. We have a 10 billion financial services and fintech in very specific subsectors. We think of healthcare. We have a large utilities platform. So we have our specializations exactly like my colleagues here on the panel, and that goes across from agriculture in our natural resources area to hedge fund specialisms within specific areas. So I think that whether you're fundraising or you're investing is critical for all of us to make sure that we can navigate our way forward. I think being a generalist, as you've said, is immensely challenging in these markets in this world.
So we really have to focus and make sure you know your partners, your financing partners, make sure that they're there, and we will be there, team. Just to give us a bit more time, make sure the market's a bit more fluid, and we're sure we can finance some deals. Are there anybody wants to have a hard question that they would like to ask any of our friends here in the room? Nobody wants to stand up on anything in particular? All right, well, I think we've pretty much done it. I think, gentlemen, thank you very much for your time, and we look forward to seeing you next year in Cannes. Thank you very much, everybody. Thank you.